Hey everyone, welcome back to Corporate Decoder. Today, Nuveen Churchill. Direct Lending Corp NCDL is issuing $100 million of new debt, and I am seeing a few crucial factors investors need to understand. Quick note, this is not financial advice, just my take on public filings for educational purposes. This debt offering is coming out at a time when the company has seen some R. Dating downgrades, and analysts believe there is pressure on their dividend coverage. So Nuveen Churchill Direct Lending Corp, also known as NCDL, is a company that mainly invests in loans to private companies that are owned by private equity firms. These are typically middle market companies, which means they are not giants, but also not tiny startups. Now let's talk about this new debt offering. They are issuing $100 million in brand new notes or bonds that will mature in 2030 with a 6.65% interest rate. They are calling these the notes. And these are essentially an addition to similar notes they already have out there, meaning they will all be treated as the same kind of debt. The price that people are buying these new notes for is 100.123% of their face value. This means they are selling them for a little bit more than their promised value, which is not uncommon in debt offerings. After all the costs of selling these notes are taken out, the company expects to receive about 99.723% of the money. That means they expect to get around $99.7 million from this $100 million debt issuance. And why are they raising this money? Well, a big piece of it is to pay down some of their existing debts. They have a revolving credit facility, which is like a line of credit that they will use this new money. To reduce it is important to remember that the company already has over $1 billion in total debt, so taking on more or refinancing it is a big part of their financial picture. Now let's dive into what this means for investors in these new notes. One of the most significant points is that these notes are unsecured. This means that if the company runs into trouble and cannot pay its debts back, the people who hold these unsecured notes will be at the back of the line. If there are any secured debts, meaning debts backed by specific company assets, those will be paid before these unsecured note holders. This also means that these notes are lower in priority than any debt their subsidiaries might have. This structural subordination is a key risk factor because the company's subsidiaries have a lot of debt themselves, around $747 million mentioned here, which is secured by assets of those subsidiaries. The money raised from selling these notes goes to Nuveen Churchill Direct Lending Corp itself, not directly to the subsidiaries. So if a subsidiary fails, the money generated from its assets will go to its creditors before it can help the parent company pay its debts. Recently, there have been some concerning news headlines about Nuveen Churchill. One such headline from Yahoo Finance on June 29th mentioned Wells Fargo cutting their rating and seeing pressure on their dividend coverage. This is important because credit ratings from agencies like Moody's and Fitch are a big indicator of how likely a company is to repay its debts are lower. Rating often means higher risk for investors. You also have to consider general market conditions like many bonds. These notes have a fixed interest rate, so if market interest rates go up significantly, the value of these already issued notes that pay a lower fixed rate will likely go down because newer bonds will be offering a better return. Another point to consider is that the contract or indenture that governs these notes does not offer a lot of protection to the bondholders. It does not put many restrictions on the company's ability to take on more debt, issue new securities, sell assets, or engage in other financial maneuvers that could potentially harm the value of these notes. This means the company has a lot of flexibility, but it also means bondholders have less say if the company's financial situation changes negatively. We default on our obligations to pay our other indebtedness CIF, and this ties into the risk of default. If the company cannot pay its other debts, like the ones on its revolving credit facility or its other securitizations, it could trigger cascading defaults. This means they might not be able to make payments on these new notes. Either this is a very real possibility given their current level of debt. We may not be able to repurchase the notes upon a change of control repurchase event. If there is also a clause for a change of control repurchase event, if a major change like a S, Al, E of the company happens, holders of these notes can demand to be paid back. But here's the catch: the company might not have enough cash on hand to actually buy back all the notes at that time. Again, this points to the potential for liquidity issues. While a trading market developed after issuing the existing notes, if the company acknowledges that getting a good market for these notes once they start trading is not guaranteed. While a market did develop for their existing notes, they cannot promise that an active and busy market will continue to exist for these new ones. This means selling these notes might be difficult, and the price you get might not be what you expect. We estimate that the net proceeds we will receive from the sale of $100 million aggregate principal amount of notes in this offering will be approximate. Lee. $99,385,000 STIBF when we look at the projected use of these funds. $99.4 million in net proceeds. Our estimated here is the breakdown they plan to use most of this to pay down their revolving credit facility, which is their main line of credit, so the immediate goal is to reduce that debt burden. But after that, they plan to use any remaining funds for new endeavors. Statements and General Business Operations, IFAS of the 31st of March 2026, our total consolidated indebtedness at par was approximately $1,139 million IF. Looking at their debt situation as of March 31st, 2026, the company had about $1.14 billion in total debt. So this new debt offering is a piece of a larger financial picture Scrollway aimed to generate attractive risk adjusted returns through current income. What is the company's overall strategy while they are issuing debt to manage their finances? Their main goal is to make money by investing in loans to middle market companies. They want to earn a steady income from these investments and aim for good returns while managing the risks involved. Scroll for financial statements. And management's assessment of the effectiveness of internal control over financial reporting. Now stepping back and looking at the bigger financial picture as presented in their financial statements, especially from their last annual report on Form 10-K for the year ended December 31st, 2025, and their latest quarterly report on Form 10. Q for the quarter ended March 31st, 2026, we see key figures. As of March 31st, 2026, the company had about $50 million in cash and cash equivalents. This is a decent amount, but needs to be considered against their total debt, which is over $1 billion. Their total borrowings as of that same date were over $1.139 billion. This includes their revolving credit facility, their various debt securitizations, which are essentially ways they package up loans to sell, and then the notes they have issued. The sheer size of this borrowing is a major point of analysis. Their total net assets were about $864 million. This represents the value of the company's assets minus its liabilities. It is a key indicator of their overall financial health. But it is important to remember that net assets can fluctuate. Looking at their investment section, their total debt investments alone were nearly $2 billion. This shows the scale of their lending operations. The equity investments add even more to their total investment portfolio, which stands at over $2.022 billion. Scroll for notes are our general unsecured obligations that rank senior in right of pay. Meant to all of our existing and future indebtedness that is expressly subordinated in right of payment to the notes. So to summarize this debt offering, Nuveen Churchill Direct Lending Corp is raising $100 million by issuing unsecured notes. Due in 2030, this money will primarily be used to pay down existing debt, but it adds to an already stat. Until debt load investors should be very aware of the unsecured nature of these notes, meaning they are lower in priority in case of financial trouble, and the fact that the company has seen rating downgrades and analyst concerns about its dividend coverage. This new debt is part of a larger financial picture where the company carries over $1 billion in borrowings. Overall, Nuveen Churchill Direct Lending Corp is navigating a challenging environment. They are issuing new debt to manage existing obligations while facing analyst concerns over its financial health and dividend sustainability. The unsecured nature of the new notes and the company's significant overall debt raise the risk profile for investors. While the company's core strategy is to generate income through lending, the current market conditions and past downgrades suggest caution is warranted. What I'm actually looking for is how they will manage their debt load and maintain operations and dividend payouts amidst these pressures. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, give it a thumbs up, subscribe for more, and join us on Discord.